You know the headline to the last 24 hours is Mike Wilson's capitulated. He's moved from 4,500 to 5,400 and all of that. Can we just start with the skew, the wide range of outcomes? Because that was the headline of the piece. The bear case versus the bull case, has it ever been this wide?
Well, not for us. I think for other people, they've had wider skews. And look, it just reflects the uncertainty that has been the case for the last several years. And quite frankly, I wouldn't be surprised if we hit both sides. You know, I mean, like, that's kind of the world we're in, which is, you know, think about this year, and we talked about this at the beginning of the year, which is we had three sort of equally similar sort of outcomes. One was a soft landing, just a Goldilocks, which is kind of consensus now, and that's our house view. Then you have the no landing, which is kind of a reacceleration, the stickier inflation, even maybe a stagflationary outcome, which is what the market was thinking about in April. And now you're back to a soft landing, but you still can't rule out a recession either, right? So, like, all of these are very possible, and you know, they could all happen with a higher than normal degree of, you know, certainty. So that's really the headline that should have been out, is that, look, nobody knows anything, right? I mean, and particularly at a point in time, and I think maybe our mistake is just admitting that we don't know as much as maybe everybody else claims to. That's called humility, something that we've learned the hard way over life. But anyways, the point here is that the meat of our report this year, or this update, was really more about how do you make money in an environment where you have basically 0% upside and the base case, and you could have 20% upside or 20% downside. And that's what clients pay us for, right? It's the process, it's understanding, okay, what kind of environment and how are we going to navigate that and manage that? So we spent a large part of the report yesterday talking about trade ideas, specific sector ideas. That's not the headline that people want to write about. That's fine. That's your prerogative. But that's what we want to talk about.
That was never going to fit in the headline.
No.
We will talk about some of that stuff in just a moment. Let's talk about the headline just briefly.
Sure.
Are you de-emphasizing the 5,400? Are you saying as a price target it's not actually that important to you and the firm? What is that?
Well, it's not important to most clients. Institutional clients don't care about the target on the S&P 500. Let's be honest. Like, they're trying to pick stocks. And look, one of the most important things we talked about in the report is alpha generation this year has been spectacular. The way we measure it with our client base, which is significant, is this is the best alpha generation, alpha capture we've seen since we've started recording it since 2010. So that's what people care about. We're trying to help them in that their process of, okay, what kinds of stocks work in this environment? Oh, by the way, when we skew from these different outcomes, you need to be ready to pivot towards different types of securities. Right now, like, our house call is it's a soft landing Goldilocks outcome. We're not that confident that we want to make that bet fully. Like, we think it's still late cycle, which means quality. Okay, large caps over small caps still. We like staples over discretionary. We have two defensive sectors, overweight, utilities and staples, because that kind of protects against slowing growth risk. So there's a bunch of different things, but the main factor that's been working is quality. Quality's been the most consistent factor, and we don't see that changing.
I just want to say that if you wrote a headline saying nobody knows anything, I mean, we could do that every day, but it probably wouldn't really gain that much attraction. I am wondering if there are certain areas that would win in either scenario, the 5,400 or the 4,500.
Well, I think that we laid it out. Once again, that's our bear case. The 4,500 scenario that's not really our bear case. That's our base case for year end originally. That obviously has proven to be wrong, mainly because of multiples, right? I think this is the main thing, Lisa, that people have either gotten right or wrong in the last 12 months, is that, I mean, a 21 multiple is, you know, in the top decile of the last 80 years. I mean, that is an expensive multiple. So the question I think investors have to ask themselves is that a fair multiple to be paying? Well, in the Goldilocks, you know, perfect soft landing, I think that's plausible. But that's where we're trading, and that's why there's not a lot of upside at the index level.
Which raises this question, are there specific sectors that win regardless of the overall index? Do you see certain areas that are kind of independent of this overall shift of whether there is this momentum in international money that pours in and keeps valuations high and sends them higher?
It's large cap quality. I mean, that is what continues. And by the way, it's not just high growth, it's also cyclicals can work in that, but it's still up the quality curve. And we show it in the note very clearly. I mean, it's been the best carry factor for the last year and a half, which is a classic late cycle winner, which is where we are. So, you know, don't overthink that. And don't try to be cute and say, well, I'm going to jump over here because I think there's better returns. There could be. Look, in the small cap and in the lower quality areas, you can't own nothing. I mean, but it's very idiosyncratic. It's very idiosyncratic. It's not a factor that's carrying well. It's okay, I have a stock-specific idea. It's a low-quality stock, potentially, that has a very unique story to itself.
Next big stop for this market, as you know, is tomorrow afternoon. We get numbers from NVIDIA. Mega cap tech, what supports that 5,400? What supports it for you? Is it mega cap tech, the Nvidias of this world? Is it elsewhere?
Well, it's basically you're assuming that multiples stay elevated, right? We didn't change our earnings forecast in this report, but we've had this sort of boom idea that we had the boom bust thesis for a while. We probably were early in calling for a recovery in earnings this year and in 2025. So that didn't change. So you have earnings coming from a lot of different groups now. I would say the biggest contributors have been technology. Energy has been a big contributor, surprisingly. Industrials, because of all the spending that's going on fiscally. So those are three major sectors that are contributing to the earnings story. But ultimately, the 5,400 is being supported by policy, right? By very loose fiscal and monetary policy. Now, you may say, well, monetary policy is tight. Not really. I mean, we have an incredible amount of liquidity coming in to pay for that fiscal. So to me, the risk in the story for the next 6 to 12 months is, do the markets start to balk at this unsustainable fiscal policy and the way that they're funding it? And we wrote about this, in detail. We have these liquidity provisions in place now, the reverse repo, which everybody knows about. The Treasury General Account can be drained if necessary to pay for fiscal stimulus in the budget if they need to. And the Fed has already said they're going to start tapering QT. Well, that's like $1 trillion of liquidity. That's pretty loose, right, to pay for the fiscal. So to me, and I think that this is something we're watching very carefully. Last fall, when multiples came down hard, it was because rates were going up due to term premium widening, meaning the bond market was starting to push back on this strategy. Right now, that's not a problem. So one of the things we're going to be watching to change our view on how things trade at the index level is, does the term premium start to widen again? We don't know, but that's what we're going to be watching.
So big risk factor is in the bond market. And in the bond market, the big focus is November. Does this have a political twist to it? An election call embedded in it?
Well, I mean, yes and no, because I wouldn't say either party has shown any fiscal discipline, right? So in other words, I think we're going to get a strong fiscal support no matter who wins the election, both in Congress or at the presidential level. The real question for markets is, how does it get funded? How is it funded? Can they fund it at a reasonable rate? Right now, the bond market seems very relaxed about that feature, which is why multiples have expanded again.
So if the bond market stays relaxed about this, which there's a lot of people predict that it will, and believe me, I get very excited about auctions, but every week people tell me that I shouldn't because there's plenty of interest at these levels. If there isn't pushback, then 5,400, is that too conservative?
Maybe. It could be. I mean, look, I can make a case for 17 times, which is what our target was originally for this year, 17, 18 times. I can make a case for 21 times. I can make a case for 22 times. That's the problem, right? We don't know. So that's why we have a wider skew. And I would say this, Lisa, that the target will be more determined probably by multiples than we're going to be wildly surprised on earnings, okay? Unless it's a recession, of course, then you'll be surprised on the downside. But I don't like, the earnings haven't really moved that much for 2024 and 25, right? If you think about since October, which is where the low last fall, 2024 earnings estimates are up a couple percent. The market's up 25, 30. So it's all multiple. So this is why you just need to be alert to things changing potentially in the bond market first, and then that will feed into the equity multiples.
When you talk about fiscal spending, to go back to John's point earlier, and the election, it's very different what the fiscal spending may be used on depending on who wins the White House. You're talking about potentially industrials, the green energy economy. This is a new industrial policy from the Biden administration that could continue or could stop short if it's Trump. How are you thinking about 2025?
Well, I mean, look, I think the industrial policy will remain strong. I mean, that's a reshoring thing, which was part of the Trump administration. So half of the industrial policy is potentially green energy, and half of it, I would say, is reshoring and the deglobalization trend. So there's going to be spending either way. It may be redirected. Like, I could see maybe the energy policy shifting back towards traditional energy, but I would be surprised if spending is curtailed in a meaningful way from that standpoint. I think we'll see changes or differences maybe in the tariffs, although recently that seemed to be more aligned. And then, of course, immigration is a big one. And that was a huge surprise this year that really nobody saw coming around the positive labor shock from immigration. So to me, that's probably the single biggest wild card, depending on who wins the election.
Bigger, not tighter, is the view coming from Alan Zentner and the team at Morgan Stanley. This economy can grow without it getting tighter and generating inflation pressure. Are you saying that could flip the other way pretty quickly based on the outcome of the election?
I think depending on how things behave, if policy really changes, but yeah, sure. If you all of a sudden shut the borders down and Trump's talking about deporting people, that would be a negative labor shock, and then we'd be in a reverse situation. So look, right now I think the election is literally a 50-50. I mean the polls are right there, 48, 49, 50% for both sides. So this is not an issue yet. We talked about this in the note too, which is that volatility in election years typically doesn't start picking up until August, September. So I think it'll be okay for the next month. This is not going to be a topic, but it can come at us quickly, probably post the conventions.